Alright, a simple hack to get ahead of most investment banking applicants is to know Excel inside out, because most of the work that you're going to be doing at an investment bank, if you're in the investment banking division, is going to be on Microsoft Excel. Exactly what you're going to be doing is building, editing, and checking various financial models for various companies. And so today I'm going to quickly define 10 of the most common financial models that you can expect to come across in your career if you enter the world of corporate finance. Keep in mind, I'm going to try and do all these definitions in less than a minute or so in order to keep it short and succinct. However, they are very complex, or a lot of these models can be very complex. And so I encourage you to go and do your own research outside of this video to learn more about each of them. Now, the first model we're going to talk about is the three statement model. This consists of three statements: the financial statement, the balance sheet, and the cash flow statement. So these three statements have key information and data on a company. So the main aim is you connect all three of them dynamically in Excel, and then when you change one thing, it impacts the whole model. So that way you know they're all linked, and one thing that changes in the business impacts the rest of the business or the business assumptions. Obviously, you need to know how the three financial statements are linked and how it all works, and so it requires a good understanding of Microsoft Excel, finance, and accounting. All right, next we've got the DCF, the discounted cash flow model. All right, so the discounted cash flow model basically takes the cash flows from the three statement model, makes a few tweaks, and it tries to predict a value, or the value of a business today, so the net present value of a business today, depending on its future cash flows, or its predicted future cash flows. So it uses its predicted future cash flows to get a value for the value of the business today, and it does that using the cash flows that we talked about in the three statement model. Next, we've got the merger model. So typically in the merger and acquisition department, they're going to be using this. So the merger model says, if you've got one company and it merges with another company, what's the total value of the combined business going to be? So that's what that model predicts. Next, you've got the IPO, the initial public offering model. So a lot of investment bankers are going to be creating IPO models to predict how a company might perform if it goes public, or how to price the company for going public. These models typically might look at comparable company analysis, so looking at what other companies that are similar size or similar industry or similar to the company in question have previously gone or been valued at pre-IPO, and how they've performed after IPO. And so they look at various factors, and so that's essentially the IPO model. Next model we've got is the leveraged buyout model. The LBO model is very common in private equity, because a lot of private equity firms are going to be doing leveraged buyouts. However, an LBO model is not an easy model to do. It's one of the more complicated models, and so if you're in investment banking and you're in leveraged finance and you're working on leveraged buyout models, it's a good skill to have if you want to move over to private equity later on. So that's the first 5 models done. Before we go on to the next 5, if you've made it this far in the video, then today's sponsor is going to be relevant for you. They are the Financial Modeling Institute. They are the place you want to go to if you want to become an expert on financial modeling. It really is as simple as that. All right, if you've got to this part and you still don't know what a financial model is, it's basically a dynamic forecast of a company's financial statements. Financial models have become the most important tool in decision making in the world of finance, and because of their importance, they're used in various industries within finance. So not just investment banking and private equity, they're used in venture capital, they're used in product development, they're used in financial planning and analysis, they're used in asset management, they're used in credit, and so on, in order to make critical business decisions. So the world's only financial modeling accreditation body, the Financial Modeling Institute, just recently launched a new program called the FMI Foundations. It's a 15-hour program, and it teaches financial modeling concepts and skills that will enable you to create powerful financial models. FMI Foundations will help you gain knowledge in optimal model design and flow, financial statements, advanced technical modeling skills, and more. So if you're interested in becoming a financial modeler or improving your financial modeling skills, hit the link in the video description down below to find out more about their program. Now, best of all, you can get a massive discount. So if you want to get the FMI Foundations course for only $135 as opposed to like $200, which it normally is, just use the code FOUNDLAUNCH. With that, let's get back to the video. The 6th model we're talking about is the sum of parts model. So this model consists of taking various DCF models and combining them together, and then any part of the business that might not be suitable for a DCF model gets added on. So you're getting a sum of all of the different parts of the business minus any liabilities in order to get a net asset value. 7, you've got the consolidation model. So this is kind of similar to the sum of the parts model, in that you're getting various different parts of the business, putting it into one financial model, and doing so in order to get a net asset value for the business. Number 8, you've got the budget model. So this is often used in finance financial planning and analysis, otherwise known as FP&A, in order to budget or forecast for a business's spending, cash flow, hiring, so on and so forth. These models are typically focused on quarterly or monthly time periods and often heavily rely on the income statement. Second to last, number 9, we've got the forecasting model. This is also used often in financial planning and analysis, and it's used hand in hand or off the back of the budget model. So it's used to forecast future spending or future cash flows given the current budget or the existing budget of the business. Sometimes in Excel, the forecasting model and the budget model might be part of one workbook. Other times they might be completely separate. And last but not least, number 10, we've got the option pricing model. Now this is most commonly used on the trading floor by traders in order to price options. Now there are two main types of option pricing models. You've got the binomial tree model and you've got the Black-Scholes or Black-Scholes model. And also these models are based on mathematical formula as opposed to assumptions. If you made it to the end of the video, I hope you learned something new. If you are new around here, make sure you smash the subscribe button. Check out the Financial Modeling Institute. All the links will be in the video description down below, and I will see you in the next video. Peace.